You may not know about this company, but it is not possible that you don't know about the famous brand Fevicol. Creative ads of Fevicol have left their imprints in the minds of people. The owner of this brand is Pidilite. But is its share strong just like Fevicol? Well, let's look into it. This company makes products like adhesives, sealants, waterproofing solution, construction chemical, industrial resins, polymers. The company is a market leader in adhesive segment. In fact, in terms of sale, Fevicol is the biggest adhesive brand in whole Asia. With 8 manufacturing plants, the company has presence in 71 countries, including US, Singapore, Mauritius. It has famous brands like Fevicol, Dr. Fixit, M-Seal, Pidilite, Fevikwik, Fevistick, Fevigum, Fevibond. 2/3 of its revenues come from urban areas and 1/3 from rural. Since last 5 years, and especially in last 2 months, the share has given very good returns. So, what are the factors behind good returns? Let us try to find out why this share is rallying. Its reason is a strong business model and continuous improvement in results. In Q1, consolidated earnings increased 60%. In Q1, consolidated earnings increased 60%. Despite record input cost, operating margins declined by just 0.8%. Earnings growth in C&B and B2B was 64% and 50% year-on-year respectively. In Q1, EBIT margin of B2B segment increased by 1.7% from 8.7% to 10.4% year-on-year. VAM prices declined from $2,200 to $2,400 per million ton to below $2,000 per million ton. It is expected that the fall in VAM prices will improve margins in second half of FY23. For FY23, management has given guidance of 20 to 24%. In FY22, operating margin of a company came at 18.6%. In the last 12 months, the company has increased the prices by 14 to 18%. Due to price hike, earnings growth of international subsidiaries of a company increased by 15 to 20%. However, brokers are not so excited about it due to its expensive valuation. Brokers are not bullish about shares. BOB Capital has recommended selling the share at target price of 1870 rupees. ICICI Direct has suggested to hold the stock with target price of 2510 rupees. Share Khan recommended buy with target price of 2250 rupees. Now, let us see why brokers are not happy. In fact, despite fall in raw material, that is VAM prices, company's input costs were at a record level in first quarter of FY23. VAM prices went up from $1,608 per million ton in Q1 2022 to $2,200 to $2,400 per million ton in first quarter of 2023. Due to higher input cost, gross margin declined by 7.4% to reach 42% and operating margin fell from 17.9% to 17.1%. Margins may remain pressure even in this second quarter. Now, management expects that timid demand in rural areas can be a headwind in the short term. Besides this, brokers feel that company's valuation is expensive. In the financial year 2023, PE may remain at 104 times, which is way above 5 years average of 67 times. Risks regarding growth and margins are not discounted in this valuation. Now, let us compare the performance of Pidilite with its peers. So, overall we can say that the company's business is very strong, but there are a lot of hurdles in the path ahead. In the last few years, the share has made fortune for investors. Now, after more than 35% return in the last 2 months, share is very close to its 52 weeks high. It has touched the target of most of brokers. So, if you are looking to buy this share, wait for 10 to 20% fall in the share.